Good morning, SP, and thank you for being with us. During this time of mandatory telework and the pandemic, you and I have had a number of conversations that we've then made available to our colleagues. And one of the wonderful things that you do here at the SEC is you take complicated concepts and explain them in a way that I can understand and others can understand, and it's really wonderful. And one of the things that's going on in our marketplace today is that there's a lot of use of economic terms. You tune into the financial news, tune into other news, and sometimes these economic terms get buzzed by without real context. And I thought that we would take 15, 20 minutes, maybe a half hour to talk about some key economic terms around information and human behavior and what that means for our economy and how people interact. And I'm hopeful that our colleagues will find this interesting, and I'm also hopeful and certainly authorize it and encourage it that they share this with their kids and others who may be just learning about economics. So thank you for your indulgence as our economist and as a former professor, and why don't we just start a dialogue on these concepts, unless you have something you want to say out of the box.
Well, since you said about human behavior, people often ask.
You might need your mic.
You said about human behavior and economics, and people often ask what's economics, and most people have the thinking that it's all about numbers and it's spreadsheets or some other macroeconomy. But really at the heart of it, economics is about human behavior. And people, when I say that, people really? I say yes, economics is about human behavior. If we raise taxes, how would they behave differently so that in the end, either we collect more or less amount of taxes. But the behavior changes, and the job of an economist, whenever they are thinking about a policy, is to anticipate how people will respond to those changes, how they will behave differently, and would the net effect therefore be desirable or not.
Yes.
So it is in that spirit. So we went a little bit off script, but since you mentioned about human behavior, I couldn't help.
No, it's exactly right.
That.
Well,
Yeah.
let's talk about the first concept, which is information asymmetry, and how humans who have different levels of information interact. I can tell you that from my days of teaching law students that understanding information asymmetry, you have a lot more information than I do, how that changes our interaction is kind of a light bulb moment. Insider trading is the classic example of information asymmetry. But talk about information asymmetry and how you look at it.
Right. Sounds complicated, but it is indeed a very foundational concept in economics, information asymmetry. And it's almost ever present. It's ubiquitous. And even though it sounds complicated, it's really easy to understand. At the core, information asymmetry means two parties in a relationship, they come there with different amounts of information at their disposal. Most of the times, of course, it's natural to expect that one will have more information than the other. And I think examples will bring this to life. And one is an IPO, initial public offering. There are promoters who are making the IPO, and they are better informed about the firm's prospects than potential subscribers to the IPO. So that's one example. Another example, which is more day-to-day kind of, is a used car seller might know more about the car than the buyer. And it so happens that Akerlof, who won the Nobel Prize, his thesis was about what he called lemons market. Cars are often called lemons because the seller knows that the car is not good, but the lemons market, that was his thesis. And that is about information asymmetry, and we will get to that.
Great. Well, so talk more about what happens in these cases of information advantage or information disadvantage. How do we look at them as economists and regulators?
Yeah. At first blush, whenever you think that someone is more informed than the other, the natural thought that comes to mind is folks with less information would be at a disadvantage. So they would suffer. That's our natural instinct, right? And that means in the context of an IPO, do promoters take advantage of prospective investors in an IPO? And reality is it's not as easy. It's not that simple. And that is the beauty of well-functioning markets.
Yeah, that's what Akerlof showed with the market for lemons. It was actually, but for isolated incidents, it was actually the seller who suffered from the information asymmetry, not the buyer, because buyers all assumed that all cars were bad.
Exactly.
So a seller of a good used car didn't get enough money for that good used car. But talk about markets and how markets help us solve these problems.
So in the market setting, so the IPO promoters, they haven't gone public yet. Prospective investors, they understandably believe that promoters of the management, they are better informed than the buyers themselves, the subscribers. So the investors therefore perceive new investment opportunities with a healthy dose of skepticism. What does the management know about the firm's prospect that I as an investor do not? How can I be certain that the prospects for the company are as good as the management seems to think they are? So in the end, investors discount the management's claims and offer to buy shares at a low price, or they say, we will walk away. This is back to the point that you were making in the car for lemons, that the buyers all assume all cars are bad. Mm-hmm. So, and they say they offer very low price. And so that's the same phenomenon will take place in the context of an IPO.
So what are some of the things that regulators and others do to bridge that gap between a skeptical buyer who will assume that the company is not what the promoters say it is, and the promoters who, let's just give them the benefit of the doubt, think they do have a good company? How do you bridge that gap of trust, that gap of information asymmetry?
Right. And that's where markets come into play. So let us imagine a management that indeed believes in its story. Okay. Believes the price investors are willing to pay is too low because investors are skeptical. But they do need, the promoters do need funds to realize the firm's prospects. They cannot do it on their own. So how would they go about convincing prospective investors and not sell shares at too low a price? Right? So the wedge between what the management believes to be the fair price and what investors might be willing to pay, that wedge is due to information asymmetry. The management recognizes that the gap would narrow if it proactively does something to mitigate that gap, that information gulf. With additional information it supplies to mitigate that gulf, that has to be credible. So they have to do certain things to make it credible, to reduce the discount that potential buyers apply due to information asymmetry. I can talk about now as to what they might do. So the management may have its own reasons to be skeptical, of course, but we are going to set those aside because they might think that investors are eager to buy my shares. Am I offering them at too low a price? Issuer needs capital and investors are looking for profitable opportunities and market participants with a regulatory assist. That's how they have devised mechanisms to provide assurance to both parties that the exchange would be at a fair price. Okay. And these assurances are at least three different assurances. Okay. So they employ, issuers or promoters, they employ at least three means of credibly communicating information to potential investors. First is they provide audited financial information for their performance leading up to the IPO using an independent auditor. And in fact, I have worked with some of the startups or some other firms, small firms, and when they are really small, they go to some local auditor. But once they see that they might be needing some outside capital, the first thing they do is they go and hire a reputed auditor. And they get their financial statements audited by the reputable auditor, like what we call Big Four auditors in this day, or some of the other auditors as well. But that's the natural action that promoters take. So what does an auditor or having financials audited by an auditor do? That reduces the likelihood of embellished past performance to make the prospects look rosy. Law also adds to this credibility by placing direct liability on auditors for faulty audits. Looking at some of the recent episodes, of course, of fraudulent disclosures, one might wonder about auditor credibility. But these are exceptions that prove the rule that audits help most corporate managements to report honestly and most investors to take greater comfort in financial reporting. Of course, not all financial reporting is the same. And the more complex the reporting, the more room there is for a greater credibility gap to emerge. Okay. So first is use of auditors. Second, in an IPO setting, promoters, they hire investment bankers. Issuers share confidential information with auditors and investment bankers. Their sign-off signals a degree of credibility to potential investors because the reputation of the investment banker is on the line. This is more likely to reduce the credibility gap with institutional investors who are repeat players with the investment bank. In short, reputation matters more when you expect to meet again and again. So it's a repeat game, as we say. The last thing that issuers do, they organize a roadshow with the investment bankers to share information with potential investors about the company. Under the US securities laws, issuers are liable for making fraudulent disclosures. For example, they would be liable for knowingly making exaggerated claims. Pigs can fly type of claims. Economists look at these roadshows as a setting in which a mutual exchange of information takes place. The management and underwriter teams learn about the potential investors' assessment and concerns. At the same time, potential investors learn about the company. SEC regulations are also helpful here. They facilitate offerings by narrowing the information asymmetry and closing the credibility gaps. SEC disclosure requirements provide a certain degree of consistency and standardization in the information that companies make available to investors. And the SEC's EDGAR system makes this information easily accessible. SEC as well as stock exchanges require the company engages underwriters and auditors to perform due diligence on the value of the company. So these are a variety of means by which promoters try to provide comfort that the claims that they are making are credible and are in the sort of reasonable ballpark as opposed to exaggerated.
Yes, and I can tell you this, that Bill Hinman has done hundreds of IPOs. You know, I've been lucky enough to work at maybe close to 100, something
Wow.
like that. We both firmly believe that every company we have seen go through the IPO process comes out the other side a better company.
Absolutely.
And part of what we do here at the SEC is we are looking at that information and trust gap and trying to devise smart regulations, liability, information requirements, third-party verification, the injection of sophisticated institutions into the process.
Absolutely.
All of that to bridge that gap. because the narrower that gap, the more trust there is, the more legitimate trust there is, the less information gap, the better the market's going to function. And I often look at our role in that light, and you most certainly help us. So let's talk about some of the effects of information asymmetry in today's markets. Today's, I'll call them COVID challenged markets.
Right. Yeah, they certainly are COVID challenged. I mean, the market seems to be doing well, but certainly all of us have been dealing with a great deal of uncertainty in the last few months. When the SEC transitioned to mandatory telework, both management and employees, we faced a lot of open questions. How would this work? How long would it last? And of course, we also faced enormous uncertainty about the COVID-19 virus and its medical effects. It pretty much paralyzed economies worldwide for a couple months. We also have spent a lot of time learning about infection and mortality rates as a result of COVID-19. So all of this uncertainty and adverse economic information, that caused enormous volatility in the financial markets, especially in months of March, April, and May. When we say volatility in financial markets, meaning that investors are uncertain, is the value 100, is it only 80, or is it 130? So rather than having uncertainty about is the value 100 or 105 or 95, the band of values expands enormously, and that is indicative of greater volatility. As the riskiness of the economy increased, so did the riskiness of financial markets. Stock market is really, it's a reflection of what goes on in the real economy. It's not unrelated to what takes place in the real economy. Fortunately, because of the Fed intervention and the steps that were taken, and also people's deeper appreciation of what this COVID-19 is about and what its effects are and how people can take precautions. For a number of these reasons, risk climbed down considerably in the last 2 months. But it's still elevated compared to the pre-COVID-19 levels. High uncertainty in the market also means that some people would be better informed than others. So that information asymmetry comes to haunt us again. And that contributes to that, as I said, information asymmetry in the marketplace. And as a consequence of that information asymmetry, one immediate consequence is market makers, dealers, they set wider bid-ask spreads and valuations are discounted. So if you are in some derivatives markets, then higher margins are requested as a result of greater uncertainty. Here again, SEC regulation has played a strong hand in reducing that information asymmetry. Take, for example, second quarter earnings reports for airlines. We now know what percentage of pre-COVID capacity or load they operate at in Q2, how much cash they are burning or expect to burn each week and month, how much liquidity they have, and how long can they operate under current conditions without having to raise more money, how many employees they have and expect to be able to keep, and so on and so forth. So all of this information helps investors understand the economics of airlines. It also helps them understand other industries and our economy more generally, because quarterly information is not only about airlines but about other industries as well. And while companies might report some information on their own, it is largely down to the materiality-based disclosure system that we have built over time. We should be proud of this system and how it has worked under these stressed conditions.
Thank you. And it does work. The requirement to provide investors with real-time information in times of stress adds comfort. It reduces those information asymmetries, and it reduces that trust gap. And I have to say, with some exceptions, I've been extremely pleased watching the earnings reports at how companies have adapted their discussions to reflect current conditions. There's not a rigidity in their reports. They don't look anything like what they looked like 9 months ago. So
another way of thinking, imitation is the sincerest form of flattery, as they say. All over the world, they have imitated what the SEC has done in terms of requiring the kind of disclosure system. And that is another proof that the system is desirable and it seems to work.
Yeah, I agree. So let's shift gears to, we talked about information asymmetry, closing the information and trust gap. There's another economic concept that people talk about a lot. It's a bit of, well, it's seen as a pejorative term, but it's really, again, a term about human behavior. And that's the term moral hazard. Can you explain the term moral hazard?
Right. So, to use non-technical terms, moral hazard occurs when you act in a manner that benefits you. So it's a self-interested behavior without bearing all the costs. So people always talk about how you're on company expense account, right? And then you might consume or do things because it benefits you and someone else is bearing costs. That's one example given. The other example is P.J. Rourke once wrote that nothing handles better than a rented car. You can go faster, turn corners sharper, and put the transmission in reverse while going forward at a higher speed in a rented car than in any other kind. In other words, people enjoy the thrill of driving rental cars carelessly and worse than they would ever treat their own car. Economists call this behavioral shift from driving safely when your own car to driving like Richard Petty when you do not own the car. That phenomenon is called moral hazard. Of course, rental car companies anticipate such behavior and raise the cost of car rental to reflect the likely careless driving. Otherwise, rental car companies would go out of business.
So, do you think understanding the concept of moral hazard is important in today's markets and what we do here at the SEC?
Absolutely. Absolutely. I will give examples, but this principle of moral hazard that serves as an underpinning for so much of the thinking that goes on. The examples that I will use to illustrate are the importance of moral hazard phenomenon. The examples are, first is about corporations, how shareholders as principals managing the moral hazard problem they encounter with their CEOs as agents. So, and the second example is about banks. Okay. So let me talk about the first example. All of us know that companies often pay CEOs with stock, or they are called restricted stock units. And the term restricted comes in because that award comes with some strings attached. Those are the restrictions. So what does the restricted stock unit do? Well, if the company's stock price rises, the restricted stock units become more valuable and the CEO benefits. The higher stock price also benefits shareholders. So that is, we call incentive alignment. I win and you win, that is incentive alignment. So you will act, you meaning the manager, CEO will act to enhance the value of the firm because he or she would benefit, but simultaneously shareholders would benefit. Restricted stock units thus give the CEO a personal economic incentive to act on behalf of shareholders. But now I'm going to talk about that this can also create a moral hazard opportunity. For example, a CEO may be tempted to swing for fences by taking on more leverage than she otherwise would, because that increases equity returns, at least in the short run. Now, of course, the shareholders or the board of directors, the board knows that the manager faces this moral hazard temptation. So to combat moral hazard, companies build in restrictions in the restricted stock unit awards. Most restricted stock units vest over several years. That means the CEO must wait until realizing the medium to long-term implications of her management decisions, thereby aligning interests for the longer term. CEO compensation, and in particular alignment of interest over an appropriate term, is an extensively studied matter in academic literature. Unfortunately, because industries have different dynamic, including, for example, different R&D cycle, think about the difference between a tech product cycle and a pharma product cycle. The search for a single best executive compensation model is likely illusory. So that means more work needs to be done. That's why we have company-specific compensation committees. So it's not one size fits all, but you have to design, these are bespoke packages that have to be designed, and that's what compensation committees try and do.
So that's very interesting, and it is off-studied,
Yeah.
but I love the way you put that, which is you put the responsibility on the compensation committee to design an incentive package that aligns the interests of the CEO in light of the dynamics of the industry and the company. Again, trying to, recognizing the different incentives in human behavior and trying to do a better job aligning them. And our job at the SEC is to make sure that those compensation packages are described in a way that shareholders can assess whether the compensation committee has done a good job aligning interests or not.
Right. Exactly.
So talk about the second example, banks. I love to hear you talk about banks and depositors and how banks make money.
And this is something that people relate to, I think, a little more, but it's a little more complicated. So banks, the way the banks work is they have 10:1 or 8:1 leverage. That means if they put in their own $10, they borrow $90 from someone else. And that's how they have $100 to play with. That's what leverage of 9:1 would mean.
So to say again, you have shareholders who put in $10, and they take that $10 and they borrow another 90.
Exactly.
Mostly from depositors, and then the banks have $100 on their balance sheet that they can make loans with or do other things.
Exactly. That's exactly. So the depositors, the banker, the shareholders will convince the depositors that it's worthwhile for them to put money with the bank. So the bankers have that $100, and the way the banks then make money is they take the depositors' money and lend it to companies and households at a higher rate. So to a depositor, the bank might be giving 1%, but to a borrower, they might charge 3, 4, 5, or 6%. So that difference in interest rate that they earn from the loans that they make and the interest that they pay to depositors, that difference is how shareholders make money. Now, once we see that, it is pretty straightforward to appreciate that if on $10 of shareholder money, the more you borrow from depositors, the more the opportunity there would be for the shareholders to make money. Right? And the riskier the loans that the bank makes, the higher interest rate it would be able to charge. So So both risk-taking and leverage are two levers that shareholders have to juice up the returns on their investment. Now, of course, if you take more of these chances, what might happen? Okay, when things are going well, people don't think about what could go wrong. But from time to time, things do go wrong. And as you increase the risk because of either leverage or because loan quality, you take more chances with the loans, type of loans that you make, the greater is the likelihood that the bank might incur a larger than expected amount of loss, and that would render the bank insolvent. Meaning, the shareholders have put in only $10. If the loss is more than $10, the bank is insolvent. They owe more to depositors than there is money available in the bank. Okay. This behavior puts depositors at greater risk. And if that risk comes to pass, or more importantly, even if depositors believe that the risk will come to pass, there can be a run on the bank with potentially many adverse consequences to the economy. Under these circumstances, the government might step in and bail out the bank. And that scenario is when the bank or the shareholders benefit, right? Because they are bailed out. So when things were going well, they were making money, and when things went bad, they got bailed out. So that benefit, that means they do not bear the full cost of their risky behavior, because some of the cost is in the form of a bailout that taxpayers bear. Mm-hmm. That is the moral hazard that bankers face.
And we use regulation to limit that moral hazard incentive. And one of the things post-2008 is that we've made it clear that there are no shareholder bailouts. Right. That to the extent there's going to be government intervention, it won't be to bail out the equity. Right. But what are some of the other things that we as regulators do to address potential moral hazard issues?
So this is one of those situations where ex ante you have to take certain steps. Because after the fact it's too late, right? So this is something that no matter what shareholders might say, that, you know, as I have used this line before, I think, and as Oscar Wilde says, I can resist everything except temptation. So shareholders might be tempted, even the best of intentions, but they might be tempted to gain some additional rate of return by taking risks. So ex ante, as regulators, be it the Federal Reserve or other agencies within the government, they have to anticipate this excessive risk-taking behavior and put in place some measures. If you increase the amount that shareholders have, that is the greater ownership, that will lower leverage. And that would make it less likely that owners might take excessive risk. In the limit, going back to the car example, if you own the car, you are not going to take excessive risk. There we said that you don't own the car, you only rent it. So it's the same concept here. If you have more, the term that gets used is more skin in the game, right? If you have more ownership, then you would be more careful. And you will not take excessive risk because now a greater amount is at stake, your own amount, and you worry about losing all of that capital, and you become a little more cautious. That potential loss serves to discipline banks against being reckless. As a result, banks are less likely to be insolvent, and the potential cost of bailout is lower. And in other words, this diminishes the moral hazard. I should note that these are not all new concepts, nor are the salutary effects of smart regulation. Deposit insurance, that came about a long time ago, is a form of smart regulation, particularly at the time it was introduced. Bank runs are less likely to occur if depositors know their money is backed by FDIC insurance. And coupled with that, we have to make sure that banks are adequately capitalized, so they are not relying on this bank insurance to bail them out. Yeah, I know that you're always on the lookout for areas where asymmetric information and moral hazard may result in suboptimal or worse outcomes. So, anything particular on your mind, So.
Well, you made a point that I want to make sure our colleagues understand, and that is there's a difference between ex ante, before the crisis, before the shock regulation, and ex post, after the shock regulatory intervention. We've seen the Fed and the Treasury with unprecedented ex post intervention, providing liquidity in the markets. And this gives me an opportunity to make a point about the SEC. People think about the SEC as a market regulator in terms of market function. We do that. They think about us as an information regulator in terms of information and responsibility for it. We talked about that, and closing those information gaps and credibility gaps. But we also are a prudential regulator.
Yes.
Our tools are largely ex ante, but we have net capital rules to ensure that brokers have enough capital if they need to wind up, that customers get their money back. We have the whole Title VII regime that we've put in place, which is designed to ensure that there's not excessive risk in the derivatives market. Our central clearing parties, we have margin rules, both for initial margin that you post when you put a trade on, and variation margin that you have to continue to provide to the clearinghouse as prices change. Those are prudential regulations. So we do engage, let there be no myth, we engage in prudential regulation here at the SEC. And it's all ex ante because we don't have capital to commit ex post.
Right.
But you and I are now looking at some of these asymmetries in light of COVID-19, and the interconnectedness project that you and your colleagues in DERA are undertaking is wonderful, because I think it's a great way to look at and look for some of these information asymmetries and potential moral hazards. One area that I know we're going to look at is the short-term funding market.
Absolutely.
And whether there's excessive leverage in the short-term funding market, and whether those who had used leverage in the short-term funding market actually had the skin in the game that was necessary for discipline. And I look forward to engaging with you and your colleagues on that. Let me just say this. I think this has been a wonderful discussion of information asymmetry and moral hazard. I hope our colleagues, and as you know, I hope in particular their children, may find this interesting. But any final thoughts, SP?
It has been really, I've been here a couple of years now, and it has been reassuring to see how much economic concepts are at the heart of SEC's regulation. They are regulation that is designed to protect investors and facilitate capital formation, and also maintain orderly and efficient markets. Of course, much work remains to be unfinished. The landscape keeps changing and new issues come up, so we have to continue to work on regulation to maintain the functioning of the markets, and I'll look forward to our continued efforts. So, thank you for giving me this opportunity.
Thank you, SP, and you're so right. Human behavior is ever changing, markets are ever changing, and we need to be ever changing. So, thank you so much.
Thank you.